your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for the Mortgage Voice, Jeff Barton.
Welcome, everybody. This is Jeff Barton, your voice in the mortgage industry. Welcome to the show. Thank you for tuning in each and every week. You know, if you want to see and hear what we do each and every week, a couple of places you can go. TheMortgageVoice.com is a great place where you not only can hear and see me, the segments of the show, but also look at the guests that do come on and find a way that you can get in touch with them at your leisure, as opposed to listening to the show and trying to find a pen to write things down. That's a good way. The other way is YouTube. Go to YouTube, Jeff Barton, the Mortgage Voice on YouTube. You can see this, as well as many, many, many other shows. We've been doing it for several years. Daryl's back with us. Daryl, how many shows have we done together now?
We have done over 400.
Okay, so at least 400 with the best in the business. And if anyone ever wanted to get on the radio, he's the guy to help you do it. And so appreciate having you back, and welcome back.
Thank you so much. I appreciate it.
Thank you very much. Okay, so at YouTube, Jeff Barton, the Mortgage Voice, you can see and hear everything you want to hear, as well as themortgagevoice.com. This is Jeff Barton. This is the Mortgage Voice. Okay, welcome back to the show. Now, I want to just briefly talk about some of the things that change people's lives and what changes people's lives and why we do what we do, really. The reason is because we've seen another sea change in the mortgage industry, and what has made people sit on the sidelines until now to do something, or what is making people more motivated to do something now than they did when rates were low. So I just wanted to, Daryl, we'll bring you in. Life-changing events. What have you experienced recently or in the past that you went a 180 in your life or 90 degree?
Well, some of the 180s are job-related, obviously, but as you get older, the health issues crop up,
right,
and make decisions for you sometimes in terms of what you can do and what you can't do. I know a lot of people that are my age and above are no longer interested in living in a two-story house.
Right.
They all want, some sort of a...
Yeah, just single story, so you don't have to climb stairs. Yeah, no, and okay.
My sister just called me yesterday and said she missed the last stair and broke her wrist.
Oh, you're kidding me.
My wife had broke her leg.
My wife broke her leg. Same thing, yeah.
Yeah, I hurt myself. That's not where I did the real damage.
Right,
but I'd fallen down a couple of stairs here as well, so...
Yeah.
Stairs, big deal. Old people, big deal.
It is a big deal. It's one of the reasons why, I guess, in that age group, my age group, Daryl's age group, that people do want to scale back, scale down, maybe get into a situation where they're not necessarily in control of the gardener and the plumber and have to fix the roof, maybe into some facility or a condo or something like that. We have been nationally in a change for some time now, but recently, within the past 6 months, obviously the war in Ukraine has really changed what we think about on a daily basis in terms of what is causing inflation to be as high as it is. Ukraine is one of the reasons. We don't really look at it as such, but when you consider that the largest grain supplier in the world is no longer supplying that grain, and any grain that was there or is being farmed is being stolen by the Russians, in that particular war. So we know that food prices, because grain, let's face it, grain and sugar in the U.S. are in everything. I mean, you can't buy anything, foodstuffs, unless you're going fresh fruits and vegetables and meat, that doesn't have one of these two things in it. So this is one of the main things, main events this year that has really changed, made us all go right. Inflation's the other one, of course. Things cost more than they have cost in a long, long time. Back to the 80s, as we've all talked about, ad infinitum, placing blame on who's to really solve the problem or who's to blame for the problem. There is no blame. There is no solve. What there is what we have as a country and how we deal with it. The other thing, of course, is COVID. COVID really set us back. If you look back 2 years ago, 3 years ago now, 2019, compared to some of the things that are happening today in both supply, in both how people were paid. In 2019, there was a great movement against paying people $15 an hour. In most places where this radio station reaches, where this signal, when this show reaches, $15 an hour was a pipe dream 3 years ago. Now, I say it like that because I believe that most people are underpaid, especially in lower wage jobs. But that is one of the major primers to what's happening with inflation. Now, that is a U-turn event. That is something you cannot prevent. What are you going to do? Tell your kid, your grandchildren, your friend, your neighbor, somebody that works for you that they can't get 15 bucks an hour because you can't afford it? Well, that particular line of thinking just doesn't resonate. I recently, in my own business, had a guy who was working for us. He wasn't getting paid huge money, but he was getting paid okay, $25 an hour. But he said, you know what, I'm going out on my own. I'm going to do something else. Now, how long before that happens in every business? Obviously, young people want to go out and prove themselves and do better. But if you were looking back at 2017, 18, 19, it probably wouldn't have happened like that. Why? Because the economy being what it is, most people needed the job that they were in, even if the wages were 10, 12, 15 bucks an hour. And that change in the way people think about the hourly employee pushing inflation to where it is right now. And I think inflation is one of the biggest pushers of it, that obviously, and oil prices pushing that particular number way into the stratosphere. But the hourly wage that people were willing to accept in 2018, they're just not willing to accept in 2022. I think that's a good thing, but it does show that not only in the menial or lower paid jobs, look, if I'm paying somebody 25 bucks an hour, and I just up the bottom guy to 25 bucks an hour. Obviously, the middle guys want to get a raise. The top guys are going to want to get a raise, and obviously that puts a big squeeze on what they call margins. Now, across all industries, and we look at it on a quarterly basis, and we're about ready to look at the second quarter statistics coming out probably in the next 2 or 3 weeks, right before the Fed open market committee meeting in July, which will probably push 50 to 75 basis points across the table as a raise in interest rates at the Fed. All of these things being what they are, and the U-turn, what I'm talking about, is not only personally, but as a nation, what we're looking at. Now we see court decisions, Roe v. Wade, that's a big changer for a lot of people. We see some, there's this committee hearing going on about the January 6th. I don't know what they're calling it, but what are they calling it?
Insurrection.
Oh, is that what they're calling it? Okay, the insurrection hearings. So the country is preoccupied with stuff. And I call that stuff because financially it matters not at all. The things that matter to you, buying a house, are what are the rates, and the rates are not good. I'll tell you what they are right now. 5.95 for the 30-year fixed. Now, it's not 6%, but it's not 4% either. 5.30 is the 15-year, 5.35 is the FHA, 5.10 is the jumbo, and 5.40 is the 5/1 ARM. Now, these are averages that a great website that we've used for years as part of our service to you is to obviously research what we're talking about. And that particular, say, the Mortgage News Daily is a place where you can go and get free information. Now, oddly enough, when we've seen inflation really attack prices across the board, and we're raising them, 8 to 10%. In some industries, a lot more than that. If you look at the real estate inflation, now they don't call it inflation, what they call is price increases, or they call it equity increase for the owner, when really 20% year over year, that's inflation, folks, and that's killing us. But regardless, if we're looking at the way prices in home prices have increased, the way other prices across the board have increased, what we're talking about here in terms of the rates and what you can afford, we're really looking at buyers right now affording how much less than they could have afforded in January. The rising rates cost the typical home buyer up to $165,000 in purchasing power. So if you were looking at a house for $500,000, and now, because rates have risen, you can't afford anything over $365,000, well, that's a problem, because there's not a lot for sale anywhere for $365,000. As everyone knows, the median house price in the U.S. went up to $407,000. That's a ton of dough in most places. Now, where this show reaches, maybe not so much. But in most of the country, that's in the middle of where the country is, that's a lot of money. Indiana, Iowa, Idaho, Oklahoma, many other places where real estate hasn't risen the way it has here in California or in Las Vegas, Nevada, where the show is, or even down in Albuquerque, where the median price is about $350,000. Anyway, I'm Jeff Barton, your voice in the mortgage industry. I really appreciate you listening to the show. Let's get back to it. I'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show each and every week. We come to you in many, many different ways, certainly by the radio stations that we've talked about earlier in the show, but also by podcasts. And if you want to join or hear or seek out any of these podcasts, we have a list of them, and they are Google, Apple Music, Stitcher, Spreaker. You got some more there, Daryl?
Sure. iHeartMedia, radio.com, YouTube, and podclips.io.
Man, he was quick to the switch. Excellent. Perfect. All right. Anyway, any of those things, you can hear this show. Look up the archives of the show. We have hundreds of shows that you can hear. Each and every week we bring to you information you're going to need if you're going to make decisions right now, or if you're planning to make a decision in the next 2 or 3 months. Thank you very much for joining. This is Jeff Barton, and this is The Mortgage Voice. All right, we bring to the show, once again, a great guy who knows a lot more about development than I ever will, but I had a lot of questions for him today because market changes, what happens if, and all those kind of questions. It's Josh Thompson from Malibu Funding, who, again, does a lot of development for himself and his partner. Josh, what's the name of your business?
It's Equilibrium Financial.
Equilibrium?
So I do development under that umbrella, and then usually we do different, LLCs per project. I have Plymouth Inglewood Development LLC, and there's just a bunch of different ones. I try to keep every project separate to its own entity.
No, I think that is true, and I think that is also the way a lot of people who are savvy in the business even hold, like if you are an investor and you own, 7 or 8 properties in different states, you usually set up a different entity for either each property or each state so that one state you get, something happens and you don't want to lean on all these other states as well.
Exactly.
Okay, so talking off air, Josh and I were talking about licensing and how long things take. I currently am waiting for a phlebotomy license from the state of California. It just seems to take on and on, but nobody takes the record but you. I mean, what did you wait? Almost 3 years for an endorsement on your DRE license?
Yep, about 3 years. Yes. And I mean, it's tough because, I think they are so understaffed
right.
that, it's really not the employee's fault, and
no.
I think, these systems are archaic, you know what I mean?
Yes, they are.
There's nothing automated. Everything has to be personally reviewed by someone, coupling that with people being understaffed and, it's just a nightmare, so something definitely has to shift in the system. I mean, it's, I don't know. I think even overall that kind of stuff has an impact on the economy, on
yep.
people's lives. People are just trying to do business and, even in the space of building housing,
yep.
what I mean? It's you hear that there's a lack of inventory. I've been hearing that for many, many years now, and the government doesn't do anything about streamlining this process or making it easier for us to provide something that's needed for the people.
That you brought this up was the next topic I wanted to talk about. I read an article today that said regulation and 40.6% of the cost of multifamily development is regulation. That's a big number.
Yes.
Oh, man.
Yeah. I mean, that is accurate. I mean, there's permitting costs are crazy. I primarily build in California.
Uh-huh.
So, there's you got the school fees, taxes for every unit you're building. You have, all these different ancillary fees, the plan check fees and all that stuff. I
yep.
mean, on this Inglewood project to build 20 houses, the permits alone are over 300 and something thousand. So, it's quite, it just makes it tough for there to be people to even do projects, you know what I mean, because of all these costs. And, you already have other soft costs that you need to pay, like architectural fees and stuff to get it there.
Sure, geology, depending on the site, it could be archaeology, it could be all kinds of environmental, all kinds of stuff.
Oh, yeah, because, if you're, most people don't do these projects with their own cash,
Right.
So if you're getting any bank financing, the banks want, the soils reports, they want a percolation test depending on where the lot is, and then when you're doing bigger projects, California has this CEQA environmental report that's required that costs a ton of money, you know what I mean? So it's tough. And then that kind of stuff can lead you to an end of, if the CEQA report comes back bad,
Right.
or saying that it's going to have a negative impact on the environment and the community. They even look at, the flow of traffic in the area. If you're increasing the density of housing in a certain neighborhood, can it support the traffic that's going to be there? And there's so many little things that, you can be hundreds of thousands or $1 million or plus dollars into, just doing your feasibility stuff on a project, and get denied because of, a small factor that comes up. So,
You mentioned not a lot of people want to jump in this just for these kind of reasons. It's like going to college, except at a lot more expensive to learn all these processes. And, of course, you haven't even mentioned the neighbors who could complain, or the guy down the street who just doesn't want to have your development done, complaining and delaying and suing and everything else.
Oh, yeah. Yeah, and it's interesting, too, because most local municipalities, once you get all the way through the planning process and, you get to a point where, the site plan is approved or almost approved, that's when they make you kind of do a presentation to the town. You have to,
Right.
everyone in your district, you have to mail out letters
Yep.
and, present the project to them. And then they wait to see how many complaints that they get. So, if there's enough complaints, that'll shut your project down, right then and there. And it's very unfair because, it's almost like the cart before the horse kind of thing. It's like, can't we figure out this stuff before we spend $1 million?
You would think.
Right. Yeah.
Right. No, I agree with you. Okay, so now that we've gotten some of the difficulties, and we talked about them, and there are plenty, tell me about the market conditions. Where are we today, and where are we going to be in 6 months?
It's interesting because I do see the market softening a bit on, more so in my experience right now. I see it softening definitely on multifamily properties.
Okay.
But and it depends on where you are. I know, like in the Los Angeles market and major metropolitan areas, I think the need for single family housing is still there, but the rates are so high, so these borrowers that, were on the borderline of qualifying at a 3.5% rate, then the rates jump up to 4.5%, 5%, 5.5%.
Right.
Now these guys can't qualify. So
Right.
I do think that, if you're a landlord right now and you have multifamily, I think rents are going to be stronger within the next 6 months and year. Just because a lot of people are kind of pushed out of the buying box at this time.
Yep.
But, there's so many conflicting views on what the Fed is going to do next. I've heard, I listened to a thing on Robert Kiyosaki's thing today.
Yeah, no, he's been in the news a lot, huh? He made a comeback.
Yeah, he did. Yeah,
He really did. For everyone that doesn't know, that's the rich man, poor man guy.
Yes, it is. Yes. So he had an economist guy on there recently in the past couple of weeks or so, and he had an interesting view. He thinks that the Fed is going that this June rate hike that they just did is actually going to be the last rate hike that they do, and he thinks within the next 6 months you're going to actually see them start to slash rates, because there's a lot of credit out there, right? So I guess, his view is that the Fed can't let the real estate market go bust because there's so much credit out there that, that would be a major issue and would lead us into a very deep recession. But, the other things that are at play, there's a lot of stuff that is outside of our control and even American control too, because of supply chain stuff. There's so much, material that we consume and product that we get from other places that, even China is still on lockdown in some cases, and they keep doing that. So, I think until the supply chain stuff gets worked out, I think we're still going to be having an inflation issue. But rates are definitely, I think, slowing things down quite a bit. So
listen, we're up against it. Could you shout out a way by which people can get a hold of you, especially if they want to know more about what you do in development, maybe get interested in doing it themselves?
Oh yeah, I mean, I'm always a call guy. So you can call me at any time. My number is 323-945-5694.
Excellent. That's Josh Thompson. Josh, thanks very much. I really appreciate you coming on again. That was great job.
All right, thank you so much.
Thank you very much. And again, I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. You know what? We are on each and every week. Number of ways that you can hear and listen to the show. Not only do we on 5 radio stations in 3 different states, we're also on a number of different podcasts, 8 to 10 podcasts, and we also have a website, The Mortgage Voice, themortgagevoice.com. You can go there, see this show, hear this show, and some past shows, as well as the guests that come on the show, a little bit about them. If you want to see and hear them and get in touch with them, that's a great place to go. Jeff Barton, The Mortgage Voice. You also can be seen on YouTube. YouTube is a great place to see this and hundreds of shows. We've done 8-9 years of shows. So if you want information from a historical perspective in a format like this, you can always go there. I'm Jeff Barton. This is The Mortgage Voice. Thanks for tuning in. Okay, so we bring to the show great guests on the show. And why I say that is because the experience and the amount of knowledge that is brought to you without the commercial, just people talking about mortgages and the problems that we have. And it's just a great way by which you can pick up information without being lectured at. And I always appreciate as the best way to do that. A new person on the show has not been, I don't think, Michael, you've been on the show before?
I have not.
Okay, excellent. So it's Michael Chapman from Chapman Real Estate and Finance, and he joins us now. Michael, how are you?
I'm doing well. How are you guys?
I'm great. Thank you very much. Okay, so you know what's happening in the economy, you know what's happening in the marketplace. When customers come to you, how do they come to you and what are they looking for? Are they looking for the Hail Mary pass, or are they, solid W-2 employees with 700 FICO score and 20% down? What's your customer look like today?
Yeah, it's kind of all over the map. And, a lot of people are not as optimistic as they were, 6 to 8 months ago.
Right.
But it's kind of it's a bit of a blessing in disguise, because I had a lot of escrows that went through where it was such a distorted seller's market. Seller's market
Right.
meaning that the seller gets to call the shots. And it was requiring buyers to, basically what I would call a suicide offer, where they're removing all their protections, their contingencies,
Right.
and just saying, hey, I want this house so bad, I'll just, whatever it takes, I'll do it. And, I saw some $100,000 over the appraised value and going like this. So now this is shifting, still a seller's market, but with a higher borrowing cost, with higher rates, it kind of calmed things down a little bit, and now people are buying houses at value. So I'm trying to tell my clients, like, hey, keep your head up. It's still a good market. There's a lot of appreciation to come down the road. We can talk about that too, why that's the case.
Okay.
But now people, even though their monthly payment might be a little bit higher, they're not throwing a bunch of money away on a appraisal differential. So
Explain that.
Yeah.
Tell people what that means, because I think a lot of people out there, we throw around the buzzwords and what we know and knowledge in the business, but what is the appraisal differential? What is that?
Yeah, so like, let's say someone's offering a house at big numbers here in California, so a million, pretty standard here, and the listing price is $1 million. They get 20 offers, and they're bidding each other up, and they end up going into contract at 1.1 million, so 1,100,000.
Right.
Okay, and then we ordered the appraisal. The lender has to have an appraisal that shows the lender that that's the value. Well, if the appraisal comes in at 1 million or 1,010,000, okay, you have an appraisal differential where the contract price is 1.1, but the appraisal came in at 1,010,000. So now you have a $90,000 differential. So if you have removed contingencies, you're stuck. You're going to have to pay that difference. If you have contingencies, you can renegotiate and see if the seller will come down. So that's kind of what's happening now with this market, where you can expect to, you should be able to buy the house at what the value is right now, and that's a big difference. So again, I'm trying to frame it for people so they're not getting discouraged, because rates have gone up so quickly. So it's like, wow, I was paying $3,000 a month, 6 months ago. Now it's $4,500 a month. Whatever, depending on the taxes.
That's right.
So,
yeah, no, it's amazing, and it always bugged me, because when you get, as you say, this differential and there's an extra $100,000 you got to come out of pocket to pay, or whatever the number is, as soon as that property closed, that's the new value of that property. so basically, right. It just makes you crazy, because why should I mean, if I'm offering this and I'm competing and I can show the competing offers and this is the price that I'm paying, but you say the house isn't worth this, 2 weeks after I close, you're using my property for the next guy's house. It's just because it makes me so crazy.
Yep.
Okay,
Definitely.
so not only is mortgage interest rates, but what are some of the programs that people are using? Is it still straight conventional 30-year fix? Are you going into non-QM? What are the kind of programs you're looking at with your clients now?
Yeah, some non-QM, but I get most of my clients from realtor referrals, so they're usually well qualified borrowers.
Great.
And what's been interesting in this market, and lenders have adjusted, is that, and this gets complicated, but the way that interest rates have gone up so quickly, it's really affected conventional conforming loans, Fannie Mae loans, more than jumbo loans.
Right.
And so a lot of borrowers are qualifying with a lower interest rate on a jumbo loan. And what lenders have done to adjust is actually set the loan limit for a jumbo. So typically that's 647, over 647 in the country, 647,000. But they've lowered that down to 500,000 just to get borrowers in at a bit of a lower rate. So
I see.
It's the way interest rates work is kind of complicated. So I don't want to get too in the weeds on that. But
no, it's interesting, and I think, if I just might interrupt you, I think a lot of what we do as loan officers and people who are in the business who understand it is to try to figure out the best way to tell our clients exactly what's going on without complicating it. And I think it's made complicated because we don't want the customers knowing. At least not us, but the banks that lend the money. They don't want the customers knowing.
Yeah, exactly. A lot of people think that it's kind of an arbitrary thing where banks set the interest rate, but it's actually all based on the bond market.
Right.
Fannie Mae and Freddie Mac, which is 90% of our mortgage loans, they are in the business of converting these mortgage loans into bonds.
Right.
And that's how those bonds trade, is how interest rates are set. It's not from the bank just kind of like dialing a knob and saying, oh, we want to make this much money and charge this guy this interest rate. So.
Well, it's interesting, yes. I think pricing in and of itself, both from the wholesale side, whether it's the bank to bank, whether it's selling to an investor, or whether it's selling to the client, it's all evolved around an ever-changing matrix to what exactly can you borrow the money for, and how much can you then turn around with competition and sell it to the client. It's not a simple process, and you really need experience, right? I mean, for you've been at it a long time. To get your client the best rate is really what we're about, to get them the best and lowest costs on the loan. How do you, now that we've just talked complex, or I have, how do you simple that down and let them know you're in good hands. What's your key to success
exactly.
there?
That's something I kind of, first of all, I am competitive rate-wise.
Right.
But that's not my first thing. When I'm talking to someone, I'm like, look, you can shop around. One lender to the next is going to be maybe an 8% difference. Maybe not even that much. Maybe it's just a $500 origination cost or something like that. But the main thing that I try to sell to my clients is that you can kind of sit back, give me the documents that I need, and I'm going to walk you through the process and kind of navigate this complicated system. So you're not having to figure out what to do next.
Right. Right.
But first-time home buyers, they've got enough on their plate with moving arrangements and paying property taxes for the first time, all that kind of stuff. So listen, let me take care of this. You're going to get a good deal, but I'm also going to navigate these choppy waters so you're not having to stress out and like, well, oh, what do I do next?
Right.
As opposed to something like you see on TV, and not to put Quicken Rocket Mortgage down. I actually use their wholesale line, but you see these commercials where it's like Rocket Mortgage, come work with us and we'll take. You're on your own. You're flying blind to you guys.
Right.
Where you're gonna get the same kind of pricing, but I'm gonna take all the what to do next stuff off your plate. So,
listen, we are up against it. Can you tell people how to get in touch with you if they want to obviously talk to a terrific and experienced person that they can trust?
Yeah, I mean, I'm happy to leave my personal mobile because that's how I do my business. So it's Michael Chapman. Give me a call or a text, 619-888-3049.
Excellent. Michael, thank you very much for coming on to the show. Great information, great insight, and we'll have you back soon. Thank you.
Appreciate it, Jeff.
Thank you. That's Michael Chapman from Chapman Real Estate and Finance. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show each and every week. We bring to you unbelievable guests, people who can really talk the shop as well as walk the walk, and that I do appreciate. If you wanted to hear past shows where we kind of do the same thing, several places you can go. We're on radio stations. We're on 5 of them in 3 different states. We certainly are on a number of podcasts. Daryl, you have the list for us? Because I can't remember it.
I sure do. We're on Apple Podcasts. We're on Spotify, Spreaker. We're on Stitcher, iHeartMedia, radio.com, YouTube, and podclips.io.
Oh, yeah, podclips.io. If you want a number of different podcasts and you want one place to go to podclips.io. They have all kinds of, as I said, different podcasters, whether it's health or whether it's lifestyle or whether it's sports or, in my case, financial. You can see and hear all really interesting people who are on there. Go to podclips.io.
And also themortgagevoice.com.
Yes, and themortgagevoice.com, and that's a great place to also see what we do, see our guests, see their pictures, learn a little bit about them, and a way by which you can contact them. Jeff Barton, The Mortgage Voice, thanks very much for tuning to the show. Okay, so back with us again is Charles Giscombe from Malibu Funding, who has been traveling the world trying to figure out what's happening both to the mortgage interest rates as well as, what's going on with the business. Are we up, we down, are we in, we out? Charles, give us your idea, and by the way, welcome and hi.
Well, thank you, Jeff, for having me again. As always, it's a pleasure to be here. Hey, man, we're in the industry. We're in the thick of it. You know? Yeah, the bottom line right now is we know that interest rates are up. We know that the market is shifting and from that standpoint. But we also know that our job is to find alternative choices and resources in order to still get deals done because the market is still out there and the market is still moving. So that's what we've been doing, just trying to find the best programs out there for people who are still trying to transact, who are, in the mix of this and trying to get deals done.
I was reading today, and I was reading about a number of lenders laying people off. First Guarantee, their 400 people got let off, I guess over a third of their sales force. I just saw JP Morgan Chase, they are firing people. This is not a great time for the mortgage industry, for people in it, but for someone who is out there looking for a home, looking for a refinance or some way, the different products available, the way that I guess products are brought to the market is usually through somebody like yourself in a mortgage company. How do you talk to the clients who are now a little confused about what's going on? They're reading as much as we are about what's happening in the mortgage industry. How do you assure them, and how do you tell them what's happening in the mortgage place, assure them that this is a very stable and good investment? Well, what's the conversation like when you're talking to these people?
That's a great question, Jeff. It's always what I try to do initially with every client is what they're hearing on the news and how they're hearing it can be very scary for a person who is not in the industry the way we are.
Right.
So if they're just the common folk who are looking to get involved with a mortgage, it sounds very scary because the interest rates are rising and rising. I just try to demystify that. I actually just try to speak to an individual and let them know this is nothing new that's happened. We had 7 and 8% interest rates before. There are a lot of people that were around doing transactions during that time. The new generation individuals are used to seeing 2s and 3s and 4s. But, we're just going back. It's cyclical, and it's going back. So what I try to do is let them know why the market shifts, why interest rates adjust, how supply and demand work in this instance and situation. Let them know what their place is and how they can be a part of this, and also give them other resources to let them know that, yes, the interest rates are rising, but there are other programs that they can qualify with, that they want to get involved with. Yes, you always want the lowest interest rate. That's what our eye sees. That's what our mind has taught us. What's the lowest interest rate? I want the best interest rate possible.
Right.
But what do you do if there are no low interest rates? If a jumbo loan is 5.63 across the board from a traditional standpoint, and a traditional conforming is going to be at a 4.6, what do you do? So this is what I try to do: explain them that everybody goes through this. Good credit, decent credit, everybody's going through the higher interest rates. So I just try to explain to them why this happens and how they can still get a transaction done, and give them alternative choices, maybe 40-year amortization and different things, interest-only options that will allow them to still have a lower payment in regards to this high interest rate market, Jeff.
Which carries more weight when you're talking to your customer? Is it the fact that it's the monthly payment we're going to talk about, so let's just concentrate on that, or is it long-term equity you're going to build if you're looking to live there and raise a family? How do you approach them? Because a lot of people just say, you know what, I can't afford the $500 a month, when really they can, they just don't want to.
Correct, and that's what it is. And I explain to them, there's 3 ways to look at the situation. Obviously, there's people that are interest rate conscious,
right?
Which anybody who is interest rate conscious needs to get their mind out of that. Obviously, you still want the lowest interest rate, but if your lowest interest rate is going to be a 5%, well, hey, it is what it is, right? That's what you have to look at. And then you look at, are you interest rate conscious, or are you check stroking conscious? Because if you're concerned about your monthly payment, we can help with that by the different choices and alternative options we have in regards to the terms that can be offered on a transaction.
Right.
So I try to hone in on that and find out from the individual, what are you most concerned with? Because people think that they're rate interest conscious, but when they find out there's an ability for them to get in a loan that doesn't have any mortgage insurance, first and foremost, if they can get in a loan that has a higher amortization, that will allow them to stroke a lower check, and that's what they're really concerned with. And so I try to focus on what is it that's happening in the industry, what can you do to lower your payment, and, if you're interest rate conscious, everybody is right now. Everybody's in that same boat, in that same bag.
Okay, the popular
That's how I try to
program.
explain it to them.
What is the popular program? The non-QM or the regular 30-year fix? What are people looking at? Basically, your customers, and whether it's an investment client or whether it's just somebody looking to buy a home for their family. What are the programs do you think? I guess are the most popular.
Well, Jeff, obviously we have a lot of individuals who are still traditional loan based. So, for a traditional standpoint, you can still do it, get your taxes. And traditional, what I mean by traditional is 2 years tax returns or W-2s.
Right.
Obviously, bank statements and paycheck stubs, all the normal documentation that you would have in the normal structure for a traditional loan. that's still going to garner you the lowest interest rate. Obviously, it's the most information that you have to provide in a transaction, but it will still get you a low interest rate. We have one of our clients that closed a loan last month, still was able to get a 4.5% interest rate loan, which they were happy with on an investment property. So
Great.
Surprising. All right. So they were satisfied with that. Individuals that are getting in right now that don't want to go by the traditional standard, it is a non-QM loan. That's a non-qualified mortgage. It uses alternative documentation to provide a full doc structure. What that means is if they may not want to provide 2 years of tax returns, but what they will be able to provide is they may be able to provide 12 months of bank statements. And what they do in a non-QM situation is they do a bank statement analysis, and they'll take those 12 months, and they'll take the mean or the average of the 12 months, and then that's how they will determine how much you make monthly. Now, obviously, in this situation, because it's just bank statements, it doesn't show your write-offs or everything else. So it just shows the actual raw deposits that you make in your account. And now that qualifies you for your loan based upon your debt-to-income ratio as opposed to what your tax returns would be. So that's going to show more money, give you the ability to qualify. And usually the DTI requirements are higher, allow you a higher threshold in order for you to qualify. So that's a great loan, all right? It still has TRID and RESPA certain guidelines, but it doesn't follow all of those in regards to tax returns and 4506Ts,
right,
which is a great loan for individuals who don't or don't want to show their taxes, maybe have filed their taxes, but they're showing lower income on their tax returns. That's a great alternative program. They also have profit and loss and CPA programs, which will allow your CPA to vouch for your time in industry, being self-employed, and also vouch for you in regards to your income and your expense factors. And that can be proven in several ways with a CPA letter and a profit and loss statement that shows how much you make and how much you spend. That can also be utilized to qualify an individual for a loan, too. So there's many other loan options that you have and resources that you can utilize to get qualified for a loan. You just don't have to be stuck in that bucket or that basket of traditional loans if you have not or do not wish to use your tax returns or the traditional paperwork that would normally be used in the transaction.
Hey, Chuck, great information. We are up against it. Could you tell people how they can get in touch with you?
Absolutely. You can reach me at 702-328-5191. That's 702-328-5191. Or you can reach me at charles@malibufunding.biz. That's charles@malibufunding.boy Isaac Zenith.
Charles, thank you very much. Once again, coming onto the show, giving us great insight, information about what's happening in the market, and also programs that people might be interested in getting for their home loans. Thanks a lot.
Thanks for having me, Jeff, always.
All right. Thank you very much. That's Charles Giscombe from Malibu Funding, Nevada. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back. Yeah.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. Each and every week, we come to you on a number of different platforms. One of the ways that we can be reached is if you go to our terrestrial radio stations. K-Tahoe is KTHO up in the Tahoe area of California. We're also on KSHP. By the way, Daryl, there's a new guy at KSHP.
You talked to Mark last week.
I
right?
talked to Mark last week, right? But now there's another guy that called
really?
me. Yeah.
Okay.
So
a new sales guy.
Yeah, exactly.
A new Herb Tarlick. All right.
Excellent. And we love our 1400 AM out there. They've been real kind to us and spreading the word about what we do. We're also on K-Mine at K-Mine Country down in Albuquerque, New Mexico, and our couple of flagships out here in Southern California, in the Inland Empire, San Bernardino, Riverside counties at KCAA. Thanks to Fred and everyone over there, and certainly at KMET. Thank you, KMET. And the guys over there and the gals that help us bring the message to those great people. And by the way, even San Bernardino and Riverside counties are seeing prices between $500,000 and $750,000 routinely. Now, when are we going to see the housing market cool off? When are we going to see things perhaps return to more normal? Well, this may be a better indicator. In April, 2.2 months of inventory nationally. And now 1 month later, and now obviously we're a month behind because of the reporting, but in May it was 2.6 months of inventory. That says to me, and says to anybody who's watching, because they watch these things very closely, obviously month to month changes. Like in the first quarter, we actually had a negative GDP, and if we get 2 quarters in a row of negative GDP, that technically is a recession. But we have so many other indicators that say, no, it's not a recession. One of the things about housing and the inventory that grows, and hopefully we will see a continued rise in inventory, which means more time on the market in order to sell. This 2.6 months from 2.2 months, that's a big deal. Normal inventory is anywhere from 4 to 6 months of inventory. Over 6 months, it's a buyer's market. Under 4 months is a seller's market. That's a good way to look at it. So when you're in your neighborhood or your particular MLS, or you're asking your local agent, make sure they give you some larger numbers, national numbers, state numbers, county numbers, and obviously your neighborhood numbers, so that you can get a real honest idea, appraisal of what's happening in the market, so that you can either price your home better or be able to put in the proper bid. Now, we've also seen the number of offers on each individual property fall. That's a good thing, too. We like to see a couple offers. We don't like to see 20 offers. That's what we were seeing last summer. We're not seeing that this summer. We're not seeing that. So let's get to a lot of news to use. There's a bunch of things in here, more David Letterman list kind of things, but that's okay. We'll get to it, because some of it's good food for thought and way by which information is passed to you more directly, because these lists are much more easy to not only compile, but also to really read it out to you, which is kind of what I'm going to do. Okay. The purchasing power we talked about, navigating a slower economy. Navigating a slower economy for both you, for your agent, for the seller, or for the buyer, for people looking for a loan. That's the important thing. So whether we're in a recession, whether we're coming into a recession, whether we're actually doing a lot better than we think, you have to know a little bit about the macro of all of this stuff before you can begin to say, okay, my job is safe. Yes, I feel secure. My neighborhood that I'm going to go to is a good neighborhood that will increase in value. The amount of money I have in the bank is great for the down payment and whatever reserves they require. All these questions, and my FICO score is awesome too. These are things that you have to consider during each economic either downturn, uptick. There are pitfalls in all of it. So, 5 high-frequency indicators for the economy. What are they? Okay, now we've gone to this before, and it's kind of a confusing thing. It's on housingwire.com. Now, the other thing, all of these services, I told you a 3 weeks ago, are now charging for this information. It used to be free, whether it's Inman News, whether it's Housing Wire, as I said, whether it's Mortgage News Daily, whether it's Yahoo or MSN, Business News. They all have now a plus beside their particular name, which means that that's what it's going to cost you more. Plus $5 a month, plus $250 a year, whatever it is. So I apologize if the information isn't quite up to spec of what it was. We are still searching out better information at a cheaper cost, and that's always the way business is done. So anyway, Housing Wire, Mortgage News Daily, a couple of these other sites that we go to, they now charge anyway. 5 high-frequency indicators for the economy. The airline industry, it's down 10.8% from 2019. Now, there's a lot of information in that other than the bare number. The main thing that the airlines tell you is it's weather-related, it's COVID-related, or they just can't find enough pilots. All of that is saying we can't manage our business. However, the numbers are the numbers. Number 2, movie tickets down. Well, obviously, who wants to go to the movies and catch COVID? I don't. I had an employee at the office catch COVID recently. He just came back after, being off for a couple of weeks. He said, this is not the normal flu. And as most people who have had it will tell you, it's a brutal thing to go through. He's fine. He's a young guy. Let's move on. Number 3, gas supply. Now, we do a lot of blaming as to why gas prices are so high. In Southern California in general, we always spend about $1 more than most people in the rest of the country per gallon. Why? Because we collect money and give it away to other people. So they figure anybody who has got a car can spend an extra $1 per gallon. I don't think so, but that's just the way it is here in California. So we're used to high prices, but $7 a gallon? No, we're not used to that. The rest of the country's hovering at about $5 a gallon. All of these things are blamed on lack of supply. Now, we went through this. We talked about it. It's not lack of supply. It's lack of capacity to refine the oil. 30% less capacity to refine oil in the U.S. than there was in 2018. The reason for that is manyfold. A lot of it is regulation. A lot of it is greed. When people make the transition from gas cars to electric cars, there's going to be a lot of gouging by oil companies, gas stations, anybody else who sees the writing on the wall. Now, maybe this is a good thing and they're investing in our future because we can't do it on our own and the government won't commit to long-term plan by which to bring gasoline to electric vehicles to the market in such a way that the oil companies don't get hurt. But that's what we're looking at, and they're down. The gas supply is down 7.9% from 2019. Okay, here's a silly one, but the New York City subway use. Now, why this is an indicator, I don't know, but it's on the list. Manhattan down 36% ridership from 2019. I think it's COVID, but I also think that it's a lot more people working from home, even in a city like New York where you can get around. Number 5, hotel occupancy down 4.8% from the same time in 2019. Now, this tells you something. It's only down 5%, let's say, where the rest of these things are almost in double digits, all of them. Why is that? Because people need a place to go, and when they travel, however they travel, whether it's by car, by plane, by bus, or by train, you need a place to stay. And so hotels aren't down as much as you might think they would be down. Okay, so we have about a minute and a half left. I wanted to talk some about why you buy a house, why you buy a house now. Real estate is one of the most important decisions you're ever going to make, and we talk about it, of course. Everybody knows that. But why is it important? Because 90% of millionaires in the U.S. did it through real estate, and really it's through the purchase of your house. You live there long enough, 20 years, 30 years, the house increases in value. If you bought in 2015, you will have seen your house increase by almost 75% since then. Now, these things don't happen. Usually it raises, especially in most of the country, 3 to 5% a year. But in sometimes we see this kind of increase, 20%. Sometimes we see just the reverse, and that's what a lot of people are worried about. So the home prices are still hot. The home builders are bracing for a shutdown. Recession may be coming. Should you buy now? I don't know. This is something we need to talk about. And any of these decisions you need to make, you need to talk to qualified people, not just a gut feeling, an uncle, a brother, somebody down the street. You need to call professionals, get them in, get them to talk to you without pressure. And that's the really important thing. Lay out a plan to talk to people when you're talking about either purchase or selling. Make sure you interview more than one person. Get a good idea as to what's happening in the marketplace so you can make the best decision possible. Listen, I'm Jeff Barton. I really appreciate you listening to the show. Always love doing it, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
NBC News Radio, I'm Brad Siegel. Police in Denmark say a suspect is in custody after a deadly shooting at a mall in Copenhagen. According to a spokesperson from Denmark's largest hospital, several people are dead. At least 3 people have been hospitalized. The suspect is described as a 22-year-old Danish man. Police are not ruling out terrorism as a potential motive. An investigation is ongoing. The mayor of Akron, Ohio, is calling for calm in his city after the police shooting of a black man.
The investigation, which is being conducted independently, will take some time to work through.
Mayor Dan Horrigan said he was beyond outraged and beyond shocked about the death of 25-year-old Jalen Walker. He was killed Monday by 8 officers who fired dozens of shots following a chase. Horrigan said ahead of the viewing of body cam footage today, he supports the rights of residents to peacefully assemble, but asked protesters to avoid violence. Police say Walker fired at them, and they say a handgun and clip were found in his vehicle. The officers are on paid administrative leave. Representative Liz Cheney is not ruling out a run for president in 2024.
I haven't made a decision about that yet, and